I'm Max Keiser. This is the Keiser Report. You know, silver, let me tell you something about silver. There is no alternative. Tina, there is no alternative. Let's bring in Stacey Herbert.
Well, Max.
Hey, wait a minute. Where were you? At some undisclosed location. Where was that? Some bunker somewhere? What's going on?
Max, all you had to do is read the strap and see that I was in Connecticut.
You had a strap on?
Listen, when you talk about silver, we're going to talk about commodities and inflation in general today. The first headline, Max, is Starbucks chief Howard Schultz attacks coffee speculators. So Howard Schultz, the president of Starbucks, the world's largest coffee chain, has attacked speculators for pushing up the price of coffee to a 34-year high. He said, quote, through financial speculation, hedge funds, index funds, and other ways to manipulate the market, the commodities market is in a very unfortunate position. This has resulted in every coffee company having to pay extraordinary high prices for coffee.
Howard Schultz, if you want to stop the price of coffee from going higher, don't let any of your customers use credit cards. Every time a customer goes into your store and uses a credit card, they're creating fiat debt out of zero, out of nothing. That's why the price of coffee futures is higher. If you knew anything about economics, you would know that. But instead, you're blaming the speculators because you're a dunderhead.
Yes, it's an expansion of money supply, and banks create it through people borrowing money from them. And you see that at the Starbucks all over the place, people using their credit cards to buy, right?
But money is loaned into existence. Less than 5% of the money in existence is actually printed by a government. The other 95% is loaned into existence from banks. And every time somebody uses their credit card, they're increasing the money supply, thus diluting their purchasing power.
In fact, he says this in his statement as well. Without any real supply or demand issues, we are witness to the fact that most agricultural food commodities are at record highs at once, and coffee is at a 34-year high. Of course, he forgets to mention the supply and demand for currency.
The supply and demand for credit.
Yes.
That's what's driving this market. Again, Howard Schultz, a guy who figured out one day that people in America might want to enjoy a cup of coffee like people in Europe, is not the guy to ask the macroeconomic considerations that are driving the price of coffee itself. No, Howard, just stay there and do your barrister thing and don't talk about economics because you're obviously completely financially illiterate.
So inflation is also in the next headline. China inflation spreading beyond food adds pressure. So China's inflation is spreading beyond food, as the headline says, signaling Premier Wen Jiabao's strategy of quarter-point interest rate increases every 2 months has yet to contain consumer prices.
Right. Well, this is part of the global currency war, isn't it? Why does China have so much inflation? It's because of all of the money that's being sent to them vis-a-vis Walmart.
That's right, but also the U.S. has been engaged in 2 rounds of quantitative easing, trillions of dollars printed. The yuan, the currency in China, the renminbi, is pegged to the dollar. So every time the U.S. prints money, every time Ben Bernanke prints money, China has to print money.
Who's the currency manipulator, China or the U.S.? That's the big question.
They're all the same thing.
Well, obviously, it's the tail that wags the dog or vice versa. You can't really say China is the currency manipulator if they're pegging to the dollar, which is being manipulated, but it's the world reserve currency, so they say, well, it can't be possibly manipulated because they live in a snow globe of denial. They're in a whirlwind of 360 degrees of fraud. They don't see that they're the currency manipulators. Tim Geithner, you're the currency manipulator.
Well, Max, it's central banks around the world. I would disagree that it's any one unique one. We're in disagreement on that one because China's M2 is up 15.3% in April alone. So they're doing a darn good job printing money. And in response to this limit down, regulators expanded the range in which gasoline and oil futures can drop in a day.
Well, again, they're appeasing the speculators. So going back to the year 2000 and the Commodity Futures Modernization Act, when they removed position limits, which are there for good reason, to prevent any one bank from dominating the entire market and manipulating prices. But they removed that piece of the regulation. And every time now that the markets get out of control, they simply remove all manner of regulation or framework or any way to buffer rampant manipulation. So the response of regulators should be to regulate, not to continuously deregulate.
Well, but it's also not a free market. They have a specific outcome they prefer. So they don't mind if the Dow continues to go up or the S&P goes up. And they don't mind if gasoline prices fall. So they'll allow extreme moves in those directions that they prefer, but they're micromanaging which direction they want.
Right. The stock market is in a bubble, and it should have margin rates increased to prevent the stock market from reaching the apex of another huge gargantuan bubble and bust. But that's being left alone because it's capitalized by the banks themselves that own the regulators. Whereas precious metals, which are the competition to corrupt bankers, they are being subjected to onerous margin rate increases in a selective prosecution of various markets. What has been called violent currency moves is resulting in a violent precious metal moves, but it's also resulting in the spread of radicalized precious metals buyers around the world.
Well, Max, listen, you know, the beginning of the whole financial crisis began with a violent currency move, and that was a violent move in the U.S. dollar, which started via the Treasury using a euro swap, remember, in 2007, and thus began the move. Silver and gold are also currencies, and so violent moves in this, we could see that we are seeing the knock-on effects in all the markets around the world. But look, they intervened in the gasoline and oil futures markets. They're introducing all sorts of margin rate hikes. First, take a look at this picture I took in Connecticut last week. You see the prices are well over $4 there for the average price of gasoline. So the headline following this reads, "Crude plunges, but someone tell the gas stations and refiners. Average price of regular rises by 2.2 cents overnight." So following that collapse in the gasoline futures, we saw gasoline prices rise.
Exactly right, because there's a disconnect between the paper market and the physical market. Because there's $700 trillion in paper around the world on a $50 trillion global GDP. And when you drill down to markets like gas, you've got oil collapsing in price while prices at the pump are increasing, because that's the actual physical market is actually going up. But the paper market is being manipulated in all manner of violent, manipulative psychopathology being practiced by these psychopathologically insane arbitrageurs and quants at places like Wall Street and Goldman and J.P. Morgan. Where were you, by the way, during that hidden period? You know, you just kind of disappeared there for a few days. You said you were in a hidden bunker.
Everybody in the world saw me on the other end.
But you had guns. You had some kind of guns. It looked like a bunker. You had one of those fish that kind of come out at you and talk like, "I'm a crazy fish, 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 fish." I mean, where were you exactly? I mean, you kind of went off the grid.
Actually, somebody in the comments section said they've never seen such a redneck room. But we're talking about all the margin rate hikes that we see. Well, Shanghai also joined in. Remember, you seem to differentiate. You think Tim Geithner and Ben Bernanke are somehow more powerful and uniquely corrupt than the rest of the world. But if you look at China, they're doing the same thing. Money supply up 15.2% in 1 month alone. And then we see this headline, Shanghai and third silver margin hike in month.
Right, and what's happening, Stacey Herbert, is that the margin rate's going to go up to 100%, which means that you've got people owning the precious metal for 100% cash, which is the same as having a gold or silver standard. So the CME, in trying to dissuade people from precious metals by raising the margin rate, is actually creating a de facto global precious metal standard. That's why I say there is no alternative. You talk to me about the price of silver, and I say to you, there is no alternative. Paper is complete nonsense. There is no alternative.
I think this is a Second Amendment issue, because you talk about all those guns behind me in Connecticut. Well, I think this is a Second Amendment issue. You know, the Second Amendment gives you the right to bear arms to defend yourself. Well, I think bearing arms in the currency financial war is gold and silver. Those are protection against the financial war.
Do you have silver bullets?
I have silver bullets. I have gold bullets, too.
Those are expensive, the gold bullets. But, I mean, silver's good for werewolves and stuff, and Ben Bernanke. But, I mean, gold, that sounds awfully expensive.
Okay, but let's move on to this headline, because I'm going to prove to you that they're trying to keep you from defending yourself against currency collapse. Dollar in graver danger than the euro. So this is Axel Merck in the Financial Times, and he says, imagine a country that spends and prints trillions to patch up any problem. Now imagine another country where there is no central treasury, meaning that bailouts are less easy, and which has a central bank that has mopped up liquidity over the past year rather than engage in quantitative easing. Of course, he's comparing the U.S. and their dollar to the European area and their euro.
Well, let me just explain something about the dollar. It's enjoying a bit of a bounce recently, tied exactly to the moment when bin Laden spectacle, ostensibly guy, Pakistan, shot, violence, filmed at 11, huge American state-sanctioned terrorist act, blood, guts, Pentagon, armed military conflict, the military-industrial complex, IUDs. It's a splatter splatterfest that we've seen, which is the basis for the rally in the dollar. There's no jobs there. There's no manufacturing there. The only thing backing the dollar is frickin' state-sanctioned terrorist acts. That's what the dollar's all about. China doesn't want the dollar anymore. India doesn't want the dollar anymore. Bangladesh doesn't want the dollar anymore. Nobody wants the dollar anymore because it's only backed up by violence. If you buy the dollar, you're buying violence. There is no alternative but silver and gold. There is no alternative.
Bangladesh and a little blip. It's not a rally in the dollar, Max.
They just bought some gold.
But listen, we don't have that much time left, and I want to show you another headline: banks driving people to suicide. So this is from Ireland, and this comes from one of Ireland's most senior high court officials. And he's speaking out about banks hounding people over debt, some of which has already been written off, and they're still hounding people to their death. He said, quote, "We know which banks were the cheerleaders for the Celtic Tiger, yet some banks are reverting to type to come to court assuming that the banker always wins anyway. That's not how the law sees it." It has for the last few years, of course. Bankers always win. But this guy, this judge in Ireland is saying, no, 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 not here, not on my watch.
This is a trend you see first in India, of course. The bankers go after the farmers. And there's an Indian farmer commits suicide every 30 minutes.
Thanks to the genetically modified currency seed.
The Monsanto is the genetically modified seed, which acts as an agricultural currency. And you see suicides in India, one every half hour. Now in Ireland, people are committing suicide to escape the predator bankers. You see this all over the world. And to escape the debtor's prison, the banker's prison, there has to be what Robespierre said many years ago. If the social contract is broken, the people must revolt.
Well, my final word is that gold and silver are a Second Amendment issue.
There is no alternative. Thanks so much, Stacy.
Thank you, Max.
All righty, don't go away. There's more coming your way, so stay right
there. Repairing a broken nation. Highway construction and humanitarian aid. But as shady officials pocket the spoils of war, it's the people who pay the price. Profiteering here is no longer just down to drug trafficking. Afghanistan on the dollar trail. On RT.
Permission free. Accreditation free. Transport charges free. Arrangement free. Risk free. Stereotypes free. Download free broadcast quality video for your media projects at freevideo.rt.com.
Hi, welcome back to the Keiser Report. I'm Max Keiser. Time now to go to New York. Speak with Reggie Middleton of BoomBustBlog.com. Reggie Middleton, welcome back to the Keiser Report.
It's good to be back.
Reggie Middleton, the last time you were on the Keiser Report, you told us how 0% interest rates were starving the banks that it was designed to save. Now, at the time, you were the only analyst in the world to mention that it would starve the banks, and you've been proven correct. So tell us more about this. What's the current status?
The current status is same as before. The banks are not making any real economic profit off of their interest-bearing assets, and they're taking losses on the liabilities, or on the assets that have become liabilities. I think also on the last time you were on the show, I discussed something that was relatively contrarian and unique as well, and that's banks that were actually willing to walk away from foreclosures. Well, Bloomberg ran a story this morning that had cities, at least 4 cities, that were suing banks for upkeep and care and maintenance on foreclosed properties. So now you have banks that actually have collateral that have a negative value to it. It's actually costing them money. So the collateral is actually proving to be the antithesis of what they anticipated. Instead of backing the loan, it's creating a deeper hole for the said loan. So not only will they probably never get the money back, they have to dump more money in. It's also difficult to see how they get out of that if the cities are going to become aggressive. And I can see cities and municipalities becoming aggressive because hard times are all over. Everybody needs the money, and if the cities see the money, they're probably going to go after it.
Reggie Middleton, let's focus on this a little bit more. So you've got a situation now where the banks, recently, it seemed as though they were getting Washington to pass some new laws to absolve them from their fraudulent mortgage selling problems, or to cut a deal and get it behind them and do some accounting tricks on their balance sheets. But what you're saying now is that the states are stepping in and they're actually suing these banks. So how much teeth do these lawsuits have, do you think, Reggie?
I don't know. I'm not a lawyer, and as far as I know, we're in uncharted waters. But the banks are legal sinkholes. The banking industry is the new tobacco industry. Not only are municipalities and cities suing the banks, you have the banks, MBA and mortgage-backed security investors and trusts suing the banks for, fraudulent practices and misrepresentation. You have the mortgagees suing the banks, the people who have been fraudulently foreclosed upon, and that is like a bottomless pit. Think about the amount of mortgages that have been taken out during the boom time. Just think about 2% of those people suing the banks. It's unlimited liability. So if you think the tobacco companies ran up legal bills, you probably haven't seen anything yet. And tobacco companies didn't run at 30 times leverage, by the way.
Right. The tobacco companies didn't run at 30 times leverage. Let's go back to 2008 for a second. We know that Hank Paulson went to Congress. He negotiated some bailout money, and this was augmented by further bailout money. Do we know what the total price tag was for the bailout money? And my second question is, based on what you're saying here, can we anticipate another round of bank bailout money, and will it be approximately the same size, or less, or more?
Well, I definitely don't know what the total price tag for the bailout is. I could give you a number that's not not an arithmetical number, and the price of the bailout is the economic future of the country. If we would have let the insolvent fail, we would have crashed, we would have hit the bottom, and we would be on our way back up. We'd have economic productivity at a brisk level. We decided not to do that. We decided to keep the oligarchs in place, and now we're dragging along. So I have absolutely no idea what the arithmetical number is, but the actual true economic cost is future growth. Now, as for any other bailouts, Bloomberg also ran another article this morning, or yesterday, stating that the banks are considering settling their fraudulent foreclosure issues with attorneys generals, etc., et al., for $5 billion. If they get away with that, that is in essence a bailout, because we're talking at least $20–25 billion of potential liability at minimum, from a realistic economic perspective. So if you could take $20–30 billion of your problems and you can buy them, sell them all for $5 billion, you've been bailed out to the tune of $15 billion.
Let me get your comments on something that's in the news. We're talking about Goldman Sachs for a moment. Two stories have come out. S&P just downgraded Goldman Sachs, and we've also got a downgrade from a Wall Street guy, Dick Beauvais, who came in and said that based on Matt Taibbi's expose in Rolling Stone magazine, that the stock's price target was lowered substantially by more than $40, and in Goldman Sachs' case, the stock is down $6 billion already today, making reference to this Matt Taibbi article. Did you read the Matt Taibbi article? You're an analyst, you're a financial analyst. Did he get anything wrong in any of his analysis, or is Matt Taibbi, he's a journalist, an investigative journalist, he's not a Wall Street guy. Some people might question his analysis, but Reggie Middleton, what do you say about his analysis? Is it accurate?
Well, to be honest, I didn't get to read the latest article by Tabby, but I can tell you I've been attempted to alert those who felt the Goldman Sachs guys have excrement that does not smell. The Goldman Sachs has been overvalued for quite some time. Starting in the spring of 2008, I've made it very clear that the amount of risk that Goldman Sachs takes in running its business and the risk of the assets are not covered by the profits of doing a business from an economic perspective. You know, they're covered from an accounting perspective, and they make a bunch of accounting earnings, and the price goes up, but they take significant risk. Over the last 2011, over the last 3 or 4 years, that risk has come to bite them. They've basically, I'm going to watch my tongue here for the first time in quite some time, but Goldman Sachs' business model is basically to take advantage of its clients. That's where the excess spread comes from. That's where they can have a trading quarter with not one loss in the entire trading quarter.
Statistically, having a quarter without 1 day of trading losses, as was the case with Goldman, J.P. Morgan, and Bank of America, I think between the three of them they had one down day in trading losses. Statistically, is that really possible?
It's just as possible as jumping off the Empire State Building and landing somewhere in California with just a broken toenail. It's a possibility, but the chances of it happening, very slim. In general, I have children, and I tell my kids very simply, when it sounds too good to be true, chances are it's too good to be true. I wouldn't want to do business with somebody who had one trading loss in 2 or 3 quarters. It's not worth the chance. It's just not worth the risk.
All right, let's talk about the stock market for a second. It appears almost as if Washington, in particular Ben Bernanke and working through the CME and other regulators, they're trying to corral people into equities. They keep raising the margin requirements on commodities, but they don't raise margin requirements on trading on equity futures. And this, based on all the economic indicators you've just discussed being in horrible shape, stock markets trading near all-time highs. Is there a disconnect there?
Well, of course there's a disconnect. I believe that the equity market has been significantly overvalued. If those who follow my blog know that the crash of 2008 and the first quarter of 2009 has never finished. The government has attempted to reinflate the bubble, which they succeeded in nominal terms in the U.S. equity markets. The problem is bubbles are not economic progress. You blow a bubble, it pops. When it pops, values usually go below the trend line, and that's not the way to do it. That's the way that policies has been conducted in this country. I disagree with it, but we'll see if I'm wrong or if I'm correct. If I'm correct, then you're going to see equity prices drop significantly. And if I'm wrong, then they're going to keep going up, despite the fact earnings and revenues and margins are going the opposite direction. And despite the fact that input costs are going up, and despite the fact that employment is going down. That doesn't sound like investing. That sounds more like, chase Bernanke and do what Bernanke does. That's not an investment, and that's not a true market with true price discovery.
All right.
Centrally planned market and centrally planned markets tend to fail.
All right, last question pertaining to the dollar. Folks say that the dollar is stronger than the euro. They look at the periphery countries in Europe and suggest that the euro is inherently structurally weak as a result of these peripheral nations. In the U.S., however, they have quite a bit of trouble based on what we've been saying right here. What is your take on the dollar versus the euro?
Both have significant flaws, have significant issues. I think that we have a triumvirate of economic superpowers, the EU, the U.S., and you have China. And each one of them have fairly unique problems, but tightly related. And the correlation between the problems are basically the bubble and how they handled it. The EU is in highly indebted stagflationary state. So is the U.S. The EU has the too many chiefs and not enough Indians problem, where they have separation of strong economic countries and the very weak economic countries that are pulling the other countries down. And they're going to default or restructure. You've heard it from me. It's guaranteed to happen. It may be called something different, but it's guaranteed to happen. That's going to do significant damage to the euro and cause rates to spike. The U.S. has too much debt and basically running a Ponzi scheme with treasuries. There's no way in the world that treasuries should be increasing in price and that rates will not go up. And then you have China, which anecdotally appears to have avoided all this because they simply ran a bubble. They opened their bank spigots. They told everybody to lend, include anything that could be considered a transaction in GDP, and it looks like they're doing well. They're going to crash. It's going to be an inflationary crash, one way or the other. I think the three powers are basically waiting for the other two to blow up. And whoever blows up last gets the win. Capital flies in that direction. That's the best that I can surmise. You know, it might not be the case, but I see the case that the U.S. is on is to be unsustainable. I see the case of the EU is guaranteed restructuring, serial restructuring in several countries, and China is rampant inflation. There's absolutely no way to deny it. So if China and the EU go before the U.S. benefits. If the U.S. and China go, the EU benefits, etc. I don't think that's a very good way to run the country's finances, but from what I'm seeing from the outside looking in, as an outsider, I can't see them doing anything else besides that, because each step that each of the three entities are taking don't seem to be fundamentally sustainable and justifiable. Politically justifiable, but not fundamentally justifiable.
All right, it sounds like what some call a currency war, and the World War III being fought in the currency pits is exactly what's going on. Reggie Middleton, thanks again for being on the Keiser Report.
Okay, well, you're very welcome. Look forward to coming back again.
All right, and that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacey Herbert. I want to thank my guest, Reggie Middleton of BoomBustBlog.com. If you want to send me an email, please do so at KeiserReport@rttv.ru. Until next time, Max Keiser saying bye, y'all.